Good morning. We begin tonight with a developing story from the world of international finance that carries significant implications for the American economy and millions of households across the nation. In the opening weeks of January 2026, financial analysts monitoring global markets noticed a striking figure appearing on trading terminals used by professionals worldwide. The number in question was $682.6 billion. This figure represents the current value of United States Treasury securities held by the government of China, marking the lowest level recorded in 17 years. To provide context, such low holdings have not been observed since the period surrounding the global financial crisis of 2008, a time that many economists regard as one of the most turbulent in modern economic history. This development is not being characterized by market observers as a routine adjustment of investment portfolios. Instead, financial experts are describing what appears to be a deliberate and sustained reduction of Chinese holdings in American government debt. The government in Beijing has been selling United States Treasury bonds at a pace that has drawn attention from analysts and policymakers alike. What makes this situation particularly noteworthy is the financial cost that China appears willing to accept in order to execute this strategy. According to market assessments, the sales are occurring at prices substantially below the original purchase values of these securities. This means that China is accepting significant financial losses on these transactions, selling bonds for considerably less than what was initially paid for them. This approach raises fundamental questions about financial strategy and decision-making at the highest levels of government. Under typical market conditions, a major economic power would not willingly accept losses of this magnitude on its investments. The conventional wisdom in financial markets suggests that when bond prices decline, holders generally wait for conditions to improve before selling. Yet China appears to be pursuing a different course entirely. The question that analysts are now examining is straightforward but profound. What would motivate the world's second-largest economy to accept losses measured in billions of dollars on its bond holdings? The answer, according to experts studying this situation, relates to considerations that extend well beyond short-term financial performance. This situation has implications for strategic relationships between nations and the balance of economic power on the global stage. When a major creditor nation reduces its holdings in another country's debt at this scale and pace, it represents more than a financial transaction. It signals a shift in how that nation views its economic relationship and its assessment of future risks. For American citizens, the consequences of these changes extend into daily financial life. The cost of borrowing money in the United States economy is influenced by the market for Treasury securities. When major purchasers of this debt withdraw from the market, the dynamics of supply and demand shift. This can lead to increases in interest rates across various forms of consumer credit. The result can be felt in mortgage rates for home purchases, interest charges on automobile financing, and the cost of carrying balances on credit cards. Tonight, we are examining what financial commentators are calling the $688 billion exit, a term that refers to the scale of Chinese divestment from United States debt markets. This represents a fundamental change in a financial relationship that has existed for decades. To understand the magnitude of this shift, it is essential to look at the historical context. In the year 2013, China's holdings of United States Treasury securities reached their peak at over $1,300 billion. For many years, China functioned as one of the most significant sources of financing for the United States government. The mechanism worked in a relatively straightforward manner. American consumers purchased manufactured goods produced in China. The dollars spent on these products flowed to China through international trade. The Chinese government then recycled a substantial portion of these dollars back into United States Treasury securities. This arrangement had important effects on the American economy. The steady demand for Treasury securities from China helped to keep interest rates at relatively low levels for an extended period. This benefited American borrowers across the economy, from the federal government financing its operations to individual families purchasing homes. However, the situation as of November 2025, extending into the early months of 2026, shows a dramatically different picture. The stockpile of Treasury securities held by China has been reduced by approximately half from its peak levels. Perhaps more significant than the total reduction is the rate at which this decrease has been occurring. The pace of this exit has shown notable acceleration over the past 12 months specifically. The timing of this accelerated selling coincides with a particular set of conditions in financial markets. The Federal Reserve, which is the central banking system of the United States, has maintained an interest rate policy that has been described as higher for longer. This policy approach has had substantial effects on bond markets. In the world of fixed income securities, there exists a fundamental relationship between interest rates and bond prices. When interest rates rise, the market value of existing bonds decreases. This inverse relationship is a basic principle of bond market mechanics. The reason for this relationship is that newly issued bonds will carry the higher current interest rates, making older bonds with lower interest rates less attractive to investors. Therefore, the price of these older bonds must decline to compensate for their lower interest payments. China accumulated much of its Treasury holdings during an era when interest rates in the United States were at historically low levels, near zero in some cases. Those bonds are now trading at values substantially below their original purchase prices due to the rise in interest rates. By choosing to sell these securities now, the Chinese government is accepting the realization of these losses rather than holding the bonds and waiting for potential recovery. Under normal circumstances, a rational economic actor would wait for interest rates to decline and bond prices to recover before selling at a loss. China's decision not to wait is being interpreted by market analysts as a significant signal. The message being sent to global financial markets is that Chinese policymakers no longer view United States Treasury securities as the safest possible place to hold their capital reserves. Instead, there appears to be an assessment that holding these securities represents a risk related to the jurisdiction and political relationship with the United States that must be reduced regardless of the financial cost. American investors and citizens frequently ask a logical question when hearing about China's reduced purchases of United States debt. If China is not buying Treasury securities, who is stepping in to purchase the debt that the federal government continues to issue? The data from recent Treasury auctions shows that the composition of buyers has indeed shifted. Domestic purchasers within the United States, along with allied nations such as Japan and the United Kingdom, have increased their purchases to some degree. However, this shift in the buyer base comes with a cost to American taxpayers. These buyers are demanding higher yields, which means higher interest rates, in order to purchase United States debt. The federal government must now pay more in interest to attract buyers in the absence of China's large and consistent demand. The current fiscal situation of the United States adds urgency to these dynamics. The national debt has now surpassed 100% of the nation's gross domestic product, a level that many economists consider significant. The annual cost of paying interest on this debt has exceeded $1 trillion. This represents a substantial and growing portion of the federal budget. Without China's historically large and steady appetite for United States debt, the special position that the dollar has held in the global economy is facing new pressures. For decades, the dollar's status as the world's primary reserve currency has provided the United States with significant advantages, sometimes referred to as an exorbitant privilege. This status is now being tested in ways not seen in generations. The mechanics of China's exit from Treasury markets are more complex than the official figures alone might suggest. Economists and financial researchers refer to what they call shadow reserves when discussing China's full holdings. While official data released by the United States Treasury Department shows $682 billion in Chinese holdings, research suggests that the actual total may be higher. It is believed that China holds additional Treasury securities through accounts managed by financial institutions in other countries, sometimes called offshore custodians. Belgium has been frequently mentioned as a location where such holdings might be maintained. However, even when accounting for these potentially hidden holdings, the trend is clearly downward. The capital that is being withdrawn from United States Treasury markets is not disappearing. Instead, it is being redirected toward other types of assets. China has been engaged in what analysts describe as a significant acquisition of hard assets on a global scale. Beginning in December of 2025, the People's Bank of China, which is the nation's central bank, has been adding to its gold reserves consistently. This pattern has now continued for 14 consecutive months. The strategy appears to be one of exchanging paper assets, specifically bonds that represent promises of future payment from the United States government for physical assets in the form of gold bullion. This transition from financial securities to tangible commodities represents a fundamental shift in reserve management strategy. This change in China's reserve composition has direct effects on conditions in the American economy, and specifically on the American middle class. When the supply of Treasury bonds available in the market increases because a major holder is selling them, and if demand does not increase proportionally, the price of these bonds must fall. As bond prices fall, yields rise. These yields on Treasury securities serve as benchmarks for virtually all other forms of interest rates in the United States economy. When Treasury yields rise, the cost of borrowing throughout the economy tends to rise as well. This is the mechanism by which a decision made by policymakers in Beijing can result in higher costs for a family in the American Midwest. A family seeking to purchase a home with a 30-year fixed-rate mortgage may find themselves paying hundreds of dollars more per month due to these broader market dynamics. The magnitude of the losses that China is accepting on these bond sales serves as evidence of a particular concern. Financial analysts suggest that Chinese policymakers are motivated by fear of what is termed weaponization of financial assets. Recent history has provided a stark example of this concern. Following geopolitical events, The United States and allied nations froze approximately $300 billion in Russian central bank assets. Chinese officials observed this action and drew conclusions about their own vulnerability. Despite holding over $1 trillion in United States assets at the time, they recognized that these holdings could potentially be frozen or seized under certain circumstances. From this perspective, accepting a loss of 20 or 30% of principal value in a controlled sale may be preferable to the risk of losing access to 100% of the assets through political action. In this sense, the losses China is taking can be understood as a form of payment, similar to a divorce settlement in ending a marriage. The Chinese government appears willing to pay this price in order to reduce the degree to which its economy is intertwined with and potentially vulnerable to decisions made by the United States government. This represents a form of economic decoupling, where two previously interdependent economies deliberately reduce their mutual exposure. We must also examine the role that changing trade policies have played in this situation. During the year 2025, effective tariff rates imposed by the United States on goods imported from China increased substantially. In various sectors, these tariffs have reached levels between 20 and 40%. This represents a significant shift in trade relations between the two nations. The overall atmosphere of the economic relationship has changed considerably. Historically, China had a strong incentive to support the United States bond market through its purchases. By buying Treasury securities, China was helping to keep the value of the dollar relatively high compared to the Chinese currency. A stronger dollar made Chinese exports less expensive for American consumers, thereby supporting China's export-driven economy. However, as the United States has moved toward what some describe as a more restrictive or embargo-style trading relationship with China, the incentives that previously existed have diminished. China's strategic interest in supporting the United States bond market has essentially disappeared. Instead, Chinese policymakers are using the dollar reserves that remain to support different priorities. There is a focus on building what is described as an internal self-reliance economy. Investments are being directed toward advanced technology sectors such as semiconductors and renewable energy, rather than toward purchasing debt securities issued by the United States government. This represents a fundamental reorientation of economic strategy. The scale of the liquidation of Treasury holdings becomes even more striking when considering the volatility it has introduced into financial markets. A significant portion of the instability that has been observed in the United States Treasury market in recent months can be traced to these large-scale movements of securities. When a participant as large as the Chinese government exits a market, it creates what analysts call a liquidity vacuum. Liquidity refers to the ease with which assets can be bought and sold without causing large price movements. The removal of such a major buyer and holder makes the market less liquid and therefore more fragile. In practical terms, this means that the bond market has become more prone to sudden and severe price fluctuations. Events or news that might previously have caused small adjustments can now trigger much larger swings in bond prices and yields. For the average American citizen who has retirement savings invested in bonds through plans such as 401k accounts, this increased volatility represents a concern. Bonds have traditionally been considered the safe portion of a retirement portfolio, providing stability and predictable income. However, the assets that were regarded as safe and stable have become notably more volatile than they have been in decades. This changes the risk profile of retirement savings for millions of Americans. One of the most significant aspects of this situation from a strategic perspective is what it represents in terms of the economic relationship between the United States and China. For approximately 20 years, the two nations were locked in a relationship of deep economic interdependence. The United States relied on China for affordable manufactured goods that kept costs low for American consumers. China relied on the United States as a market for its exports and as a safe place to invest the dollars earned through trade. This mutual dependence created a form of stability. Each nation had a strong incentive not to take actions that would severely damage the other's economy, because doing so would harm their own interests as well. This arrangement has sometimes been compared to a concept from nuclear strategy known as mutually assured destruction, where two parties refrain from conflict because both would be devastated by it. The economic version of this concept held that the United States and China were too economically intertwined to allow their relationship to deteriorate severely. The current liquidation of Treasury holdings at a substantial financial loss signals that China is prepared to move beyond this framework. By accepting these losses and reducing its exposure to United States financial assets, China is indicating a willingness to operate in a world characterized by separation rather than integration. The alternative relationships being cultivated involve increased trade and financial ties with the BRICS nations, which include Brazil, Russia, India, China, and South Africa, as well as expanded engagement with countries in what is termed the Global South, including nations in Africa, South America, and Southeast Asia. The proceeds from the sale of United States Treasury securities are being used to fund infrastructure and development projects in these regions. This represents a redirection of Chinese capital away from the United States and toward building economic relationships in other parts of the world. From the perspective of those analyzing the American economy and its fiscal situation, the current trajectory suggests what some are calling a critical scenario. The United States Treasury Department is currently in a position where it must issue record amounts of new debt simply to pay the interest on previously issued debt. This situation is sometimes referred to as a debt spiral. Such an arrangement can function as long as there is a sufficient supply of willing buyers for the debt at acceptable interest rates. If the third largest foreign holder of United States debt continues to reduce its holdings, and if other major holders follow suit or simply fail to increase their purchases, the Federal Reserve may be forced to take extraordinary measures. One possibility that has been discussed is a policy known as yield curve control. In simple terms, this would involve the Federal Reserve itself purchasing Treasury securities in whatever quantities necessary to keep interest rates at targeted levels. This is another way of describing the central bank creating new money to buy government debt that other buyers are unwilling or unable to purchase at the desired interest rate. For American citizens, the implications of such a policy relate directly to inflation. When the Federal Reserve creates new money to purchase government securities, it increases the overall money supply in the economy. An increase in the money supply, if not matched by an increase in the production of goods and services, leads to inflation. Inflation means that the purchasing power of each dollar decreases. The same dollar buys less than it did before. This is the direct connection between these high-level financial market operations and the daily experience of American families. When China sells Treasury securities, and when the Federal Reserve responds by creating money to purchase them, the result is that grocery bills increase, gasoline becomes more expensive, and the cost of living rises across the board. This represents the fundamental accounting reality of managing a global reserve currency that is under significant stress. The $688 billion figure that describes China's exit from treasury markets also serves as a warning about what financial professionals call duration risk in the banking system. Much of the debt that China has been selling consists of long-term bonds, specifically those with maturities of 10 years and 30 years. By selling these long-term securities in large quantities, China is pushing up interest rates at what is called the long end of the yield curve. This has particularly damaging implications for the United States banking system. Many regional banks across the country hold substantial portfolios of these long-term treasury bonds on their balance sheets. These bonds were purchased when prices were higher and yields were lower. As China's selling pressure drives prices down and yields up, the market value of the bonds held by these banks decreases. While these losses may be unrealized, meaning the banks have not yet sold the bonds and locked in the losses, they still represent a weakening of the bank's financial position. This situation is similar in nature to factors that contributed to banking sector stress in early 2023. The memory of that period of instability remains fresh for regulators and bank executives. The concern is that continued pressure on bond prices could force banks to realize these losses, potentially threatening the stability of institutions that are important to local and regional economies across the nation. Beijing's strategy in reducing dollar holdings and diversifying its reserves is also about achieving what policymakers there describe as currency sovereignty. By reducing dependence on the United States dollar, China is attempting to insulate its economy from decisions made in Washington. Increasingly, China has been working to settle international trade transactions in its own currency rather than in dollars. This includes negotiations with oil-producing nations in the Middle East to conduct energy trade in yuan rather than dollars. Such arrangements, if they become widespread, would directly challenge the petrodollar system. This system, which has existed for approximately 50 years, has required nations around the world to hold and use dollars for energy purchases. This created a permanent global demand for dollars, which has been a foundation of American economic power. Every $1 billion that China removes from dollar-denominated assets represents a small reduction in the dollar's dominant position in global finance. The losses that China is accepting, estimated to be in the tens of billions of dollars, would be considered a catastrophic policy failure in most nations. In democratic countries with regular elections, such losses of public funds would likely result in significant political consequences for those responsible. However, for the Chinese government, these losses are apparently being viewed as a strategic investment in long-term national security and economic independence. The willingness to accept such costs indicates a judgment that avoiding potential future risks is worth the certain current losses. The concern being addressed is the risk of financial assets being frozen or seized as a tool of foreign policy, similar to what occurred with Russian assets. By reducing holdings now, even at a loss, China is reducing its vulnerability to such actions in the future. This level of commitment to reducing dollar dependence has surprised many analysts in Western financial institutions. For years, the conventional wisdom held that China's large holdings of United States debt made confrontation unlikely, as China would not want to undermine the value of its own assets. The current actions demonstrate that geopolitical considerations and the desire for strategic independence can outweigh purely financial calculations. China is not simply discussing the possibility of a multipolar world with multiple centers of economic power. It is actively spending resources to help create such a world. Examination of detailed data from the Treasury International Capital Reporting System in early 2026 shows that the trend of declining Chinese holdings has been steep. There have been individual months where reported holdings decreased by more than $10 billion within a 4-week period. This rate of selling suggests a sense of urgency in Chinese policy circles. Whether this urgency stems from preparations for potential additional sanctions, concerns about further deterioration in diplomatic relations, or strategic planning related to other geopolitical objectives, the financial reserves are being reorganized. The structure of China's foreign assets is being reconfigured for a global environment characterized by division and potential conflict rather than cooperation and integration. For the American taxpayer, the full cost of this unwinding of the financial relationship is only beginning to be felt. The United States economy is transitioning from an era in which capital was abundant and inexpensive to an era in which capital is scarcer and more costly. In a global financial market where the largest foreign buyer of United States debt has withdrawn, the United States government is no longer in a position to dictate terms. Instead, the market itself determines the interest rate that must be paid. The market is currently demanding significantly higher compensation for the perceived risks of holding United States debt. This represents a new and more challenging reality for American fiscal policy and for the American economy as a whole. The era of seemingly unlimited low-cost borrowing for the federal government is drawing to a close, with implications that will affect every sector of the economy and every American household.